For over 2,000 years, investors had one golden rule: when the world went crazy, buy gold. But right now, the global economy is fracturing in ways we haven't seen since World War II. Inflation is sticky, fiat currencies are volatile, and geopolitical tensions are at an all-time high. Yet, gold isn't acting the way it used to. Traditional foreign exchange havens like the Swiss franc and the Japanese yen are behaving erratically. If you are holding gold or cash thinking you are safe, you might be walking into a massive trap. In this video, we are uncovering the brutal truth about FX havens right now, why the old playbook is broken, and exactly where you need to park your money to survive the next shift. To understand if gold is safe, we first have to look at its closest competitors, traditional safe haven currencies. Historically, when markets panicked, money flooded into three places: the US dollar, the Swiss franc, and the Japanese yen. But look at what's happening today. The Swiss franc, CHF, Switzerland's central bank, has fundamentally shifted its monetary policy. They are actively fighting to prevent their currency from becoming too strong because it hurts their export-heavy economy. You are no longer guaranteed a stable ride here. The Japanese yen, JPY, the yen has suffered historic structural devaluations. Decades of ultra-low interest rates and massive national debt have stripped the yen of its ultimate defensive crown. When traditional currencies lose their defensive edge, capital has to go somewhere else. Naturally, it flows back to the oldest asset on Earth. But this has created a massive anomaly in the gold market. For decades, gold followed a strict mathematical relationship: when real interest rates went up, gold went down. Why? Because gold pays no dividend or yield. If bonds are paying you 4% or 5% guaranteed, holding a heavy yellow metal looks unappealing. But recently, something unprecedented happened. Central banks raised rates aggressively, yet gold didn't crash. In fact, it broke to new highs. Why is the old textbook broken? Because the current gold rally isn't being driven by retail investors or Wall Street hedge funds. It is being driven by global central banks, specifically in emerging markets. Countries are quietly de-dollarizing. They are watching weaponized financial systems and frozen foreign reserves, and they are realizing that physical gold held in their own vaults is the only asset that carries zero counterparty risk. But does that mean it's safe for you? Before you convert your entire portfolio into bullion, you need to understand the hidden risks of the modern gold market. First, the liquidity illusion. If you buy physical gold, you pay a premium over the spot price. When you sell it, you sell at a discount. In a fast-moving crisis, liquidating physical gold quickly without losing 5% to 10% of your value is incredibly difficult. Second, the paper versus physical divide. If you are buying gold ETFs, you don't own gold. You own a piece of paper tracking the price. In a systemic banking failure, paper gold contracts can be settled in cash, not physical metal, leaving you exposed to the exact fiat currency you were trying to escape. Third, opportunity cost. Gold is a shield, not a sword. It protects wealth, it does not create it. While your money sits in dead metal, you miss out on compounding yields and undervalued equities that thrive during structural shifts. The old financial playbook is officially dead. If you are still relying on traditional strategies to protect your wealth, you are playing a losing game. The markets have evolved, and your defense mechanism has to evolve with it. Welcome to the new FX Haven playbook. This isn't about guessing where the market goes next, it's about positioning your capital so that no matter which way the global economy fractures, you are protected. I have distilled this strategy into 3 distinct, battle-tested actions you need to take right now to secure your portfolio. Let's break down strategy number 1. Reevaluate the US dollar cash position. Despite structural flaws, the US dollar remains the world's cleanest shirt in a dirty laundry basket. Utilize short-term treasury bills to capture yield while maintaining maximum liquidity for market drawdowns. 2. Implement a tiered gold strategy. Do not go all in on physical or paper. Split your safe haven allocation, keep a small percentage in physical custody for worst-case scenarios, and use highly liquid, physically backed ETFs for tactical trading. 3. Monitor central bank accumulation. Watch the actions of major institutions. If central bank purchasing slows down, the artificial floor beneath the current gold price could collapse, exposing retail buyers to severe downside. Is gold still safe? Yes, but its role has changed. It is no longer just a hedge against inflation, it is a hedge against systemic geopolitical shifts. The old FX havens like the yen and franc are compromised. Gold offers the ultimate protection against institutional instability, but only if you manage the liquidity risks and avoid overallocating. If you want to protect your portfolio from the next major currency shift, let me know in the comments. What percentage of your portfolio is currently in cash versus gold? Are you more worried about currency devaluation or market liquidity? Don't forget to like and subscribe for more macroeconomic analysis. See you in the next video.